This example returns back to FedEx stock chart, where it had been on a long-term uptrend and formed a sharp peak, falling into a more neutral range. Here, it was unable to get back to the original high, and that set the market on a more neutral to bearish tone. Familiar candle patterns appear, such as the bearish engulfing, and as the range extends, there are more familiar candle patterns along the way, forming many clear swing points. Similar to previous examples, the chart is showing heavily bearish context that is likely to continue, especially as the last few candles have strongly closed below this key lower boundary, and that will result in a high chance of lower prices. It's interesting to note these three candles are presenting the general price action of a morning star, and it even comprises an inverted and bull hammer for seemingly bullish price action. However, in the longer term context, the overwhelming stance is still bearish given the candles are overwhelmingly red, volume is also increasing, and this downward continuation has begun its final completion. It is another great example where a strong downtrend will still be slowed down by some temporary bullish price action at a key support range. Classic Harami's form here, with large red mother candles followed by the smaller baby candles fully contained within the real body range, and that serves to demonstrate the market is on an indecisive to slightly bearish tone as the market slowly declines from this key 220s range that has just been breached. Naturally, the green candle puts doubt into the existing downtrend, and this is why Haramis are separate from regular 2 candle patterns, as they can often lead to indecisive price action, as seen with this doji and spinning top, keeping the price action quite flat. Like regular reversal candle patterns, it is best for the market to immediately trade above the high of the Harami for a more likely reversal. This does indeed occur, but given the indecisive nature already demonstrated by the Harami, it is less likely to be a strong trend unless there is a rapid bullish acceleration in the very near future. Naturally, the prior continuation offers the first major resistance range, and this slows down the development of the relatively weak uptrend. Not surprisingly, there is resistance now, and it is with another Harami, except in this case in a bearish context. As per usual, when looking for a more likely downtrend, it is best to have the next candle trade below the low of this Harami. This does indeed occur, and with increasing selling volume. Keeping in mind the longer term context, the market hasn't decisively reversed the downward continuation because it has not passed its lower support range. Only after it passes firmly into the 230s can the market begin to be recovering from the strong continuation here. But in the short term, there is bullish context due to another Harami forming at the lower boundary of this narrow and contentious range. This Harami is also likely to be slightly more bullish due to the baby candle being an inverted hammer. This is indeed the case as the market goes bullish to flat with a marginal upswing. This is then countered by a marginal downswing to take the market back to a very similar situation, forming a Harami at this lower boundary, and there is slightly more bullish intent due to the gravestone doji that acts very much like the inverted hammer to show some bullish intent. However, it should be noted this is extremely weak bullish sentiment given that the volume is at very low levels and the 2 candles are not able to close above the high of the original red candle that began the Harami. There is definitely weakness but as long as a minor surge of bullish volume comes about to move over the highs, another minor upswing can begin. This is indeed the case, and there are some drastic moves in the very short term. However, this is all inconsequential in the bigger picture until FedEx can finally exit this range. In this case, there is resistance re-emerging once again to block a decisive entry into the 230s with yet another Harami in a bearish context. Some volatility emerges. However, the bigger picture still sees a bearish context and the market is unable to clear into the 230s. Instead, a strong spike lower reestablishes the existing long-term downtrend for another trip decisively under 220. It is a familiar sight where the market rushes down after the breach of a key level, combined with the catalyst of increasing red volume and candles. But remember, even the strongest of moves cannot last forever. A downward overextension is likely from such a short-term but steep drop, and this is quite possible given that there are a cluster of reversal candles appearing now, beginning with the bull hammer, and the last three candles generally show inverted hammer price action for bullish intent. In fact, they form a morning star for a more likely reversal, at least in the short term, back to more of a bullish stance. Instead, there is the exact opposite with a strong close lower. Similar to the Walmart example, there is a negation of clear technical factors due to the catalyst of the second quarter report. Remember, quarterly reports are events that are volatile and largely unpredictable in terms of the market's reaction to them. In some cases, such as in the Walmart example, price can jump higher after such a major event. However, given the longer-term context of this FedEx example being bearish, that was less likely, even in the face of this more bullish short-term development. The market drives lower, but eventually forms a minor upswing. This leads to a sizable uptrend. That is another example of a more passive rise, as the bullish price action and volume is not exceedingly strong, and the market has a relatively easy time getting back up due to the near absence of strong selling pressure due to the downward overextension. Just by looking at the steep decline here, especially in the last portion, there is a clear overselling occurring in the market, and that allows for an easy upswing with relatively low opposition. This is not a bullish engulfing, and there is too much overlap to be a strong bullish kicking pattern. However, when these two candles are combined, they do form a larger candle with a longer lower wick for a bullish context that is adequate to reverse the market. Inverted hammers form around this now established lower support range, and it also leads to the development of a morning star with that general U-shaped price action and gaps between these three candles, along with increasing bullish volume. However, this was a relatively weak upswing. The next candle did trade above the high of the morning star, however it was red, and the volume that followed was relatively low and volatile with the candle price action at times. That led to weakness approaching the resistance offered around the 170 level, which happens to be a very round number that crosses over several key events on the chart, such as these swing points and the approximate gap down level of the quarterly report. This is an interesting case where a clear bearish star is followed by an evening star. The general price action is neutral to bearish from the beginning due to the two dojis, followed by a red candle that has a larger real body in comparison. During this rapid fluctuation in the market, there is technically a Harami. However, this is almost like a bullish engulfing pattern due to the baby candle being exceedingly large, and it almost encompasses the mother candle if it was just a bit bigger. That, coupled with the massive increase in volume and immediate confirmation, made for a rapid counter to this near equally strong downtrend. Immediate confirmation with a strong close above the Harami's high, leading to a sizable uptrend, recontacting the upper boundaries of this range where there is natural resistance with familiar reversal candles. Also note, this upswing from the Harami was more bullish due to this candle having some features of a longer lower wick similar to a bull hammer. The reason why Haramis generally have more indecision associated with them compared to other two candle patterns is because the baby candle is often under the influence of being confined within the range of the mother candle's real body. However, the multiple bullish factors in this case easily overcome the mother candle's influence. Here is another case of a resistance being passed by a row of bullish candles with normal but consistent volume. However, it is likely to be a short-lived break higher due to the emergence of a clear bearish star. There is quick confirmation of this bearish sentiment as the market trades and closes under the bearish star's low quite rapidly. The return back down to the 150s sees another situation in the spectrum between a bullish engulfing and heavily overlapping kicking pattern. Here the red candle is not fully engulfed by this next green candle. However, there is heavy overlap for a very loose interpretation of an overlapping kicking pattern with very low strength. A bullish engulfing renews bullish sentiment to remain within this trading range, which is less significant in the long term as this is only a minor range within the bigger picture. It is a steep incline that is growing in strength with increased volume and a near vertical surge over 170, all after the immediate confirmation of the bullish engulfing with a strong close above its high. A gap down due to an earnings report, and prior to that, there was natural flat price action due to caution in the market before such a catalyst event. An immediate obstacle at the still firm lower 150s. Unsurprisingly, there is strong bullish context here with a piercing pattern forming, and even though this first candle has too long of an upper wick to be a strict bull hammer, it still has the same general features with a longer lower wick. The piercing pattern on its own is less significant, especially without an immediate close above its high, and this is indeed the case with the market resuming a more bearish stance. It is a familiar situation where the market neutralizes the short-term bullish sentiment even at a strong support range, and once there is a strong close under the reversal candle's low with increasing volume, the market does the exact opposite of what would be expected in the short term. It's another good reminder to not get too caught up in the short-term context and take into account the bigger picture. Now that the market has breached 150, a lower continuation is much more likely. This does indeed occur. At this point, take note of the declining volume and the smaller size of the candles that are moving in a more neutral to slightly downward sloping range. This is evidence much of the selling pressure was expended during the initial gap down and breach of the lower 150s. It is indeed a downward overextension with a large decrease in selling pressure that turns the market on a more neutral course. Here there is even more indecision, with a Harami appearing with the baby candle being relatively balanced, and as per usual, a bullish reversal is more likely only if the next few candles begin strongly closing above this Harami's high. This is the short-term context. It is good to also zoom back out and take a look at the bigger picture, where there is still an overwhelming downtrend with ample room to continue moving some distance lower. 137 is a likely candidate for the next major long-term support because it originates back here, where ever since the market reached it, it has had a major influence on trading activity, increased bullish sentiment with the current candle closing above the Harami's high. In the process, it also creates the general U-shaped price action of a morning star, along with elements of a bullish kicking pattern due to the small gap between the real bodies of the last two candles. This is another great example where immediate follow-through is key for a rapid upswing. This is especially true for Haramis. If there was a delay in closing above its high, there would have been a greater chance of indecisive and flat price action on 137, in turn increasing the chances of a downward continuation. Depending on how strict the criteria is, some patterns here may or may not be considered Haramis. This is in regards to how acceptable it is to have the real body or even the wicks of the second candle move outside the real body or even high-low range of the first candle. If a more loose interpretation is applied, then these first two swing points are Haramis. The same price action is still present in that the real body of the second candle is trading within the real body range of the first candle. The first and third Haramis are great examples of Haramis in directional context, while the second Harami shows neutral to directional price action that is more commonly associated with Haramis. Here is an inverted hammer with a slightly longer lower wick that is bullishly engulfed at the major 137 level. However, this short-term bullish sentiment is neutralized once again when the market strongly closes under the reversal candle pattern's low. The result is another rapid downward continuation that is finally halted with a strong bullish engulfing pattern that begins a sizable recovery.